Hi, this is Ivan Aligne, the founder and chief investment officer at AWAIM. Thanks for joining me today. I wanted to go through a few things, a few charts. People always find charts very interesting, and we try and share the more interesting ones. Also, if you want to take a look at our website, there's a new executive summary for the third quarter, which covers all of our published research and just highlights it all into one document and summarizes our current outlook and concerns, but also opportunities that we see in the marketplace. So first chart that I'd like to share with you is one that looks at household consumption in Europe compared to the United States. And what's very interesting is, and this was a chart published by the Financial Times, they show real household consumption, which the US just looks absolutely phenomenal in terms of its continued trajectory upward. Comparing it to the Eurozone and looking at that dashed line, which is the trend line from 2013 to 2019, looking at the UK, looking at Japan, which really has just languished since the pandemic. When you look at this chart, it becomes very obvious that the United States and its consumption has actually been supporting the world, essentially. So this is of some concern when there's a concentration in any kind of asset class or in consumer behavior. Here we're seeing quite a bit of the consumption concentrated within the United States. So that means the world economy is fairly dependent upon and quite vulnerable relative to other parts of the world based on the feelings and the behaviors of the US consumer. Next, since we are in an election year and we're only a few weeks away from the election date, it's kind of interesting to look at the top 1% versus 5 to 1%, 10 to 5% in terms of income earners, and what is the share of total federal income tax paid by these different tranches of income earners within the United States. And this chart that you're looking at right now shows that the top 1% pays essentially 46% of the total federal income taxes and only represents 26.3% of total adjusted gross federal income. So this is kind of an important item, because with the idea of increasing taxation, the top 1% is certainly paying their share relative to the amount of income that is being earned by them. They're certainly paying almost half of all federal income tax. And so when you look at these other tranches, whether it's the 1 to 5%, the 5% to 10%, 10% to 25%, you can start to imagine that the government may want to diversify or spread the burden around of taxation. And so you can see that it really isn't just about the top 1% and their earnings and having their taxes go up. There's probably a sentiment within the government that says, look at this. There's a lot of people that could be paying a lot more in taxes. And what about that 1 to 5%? They're only paying 19% of federal income taxes, and they represent 16% of adjusted gross income. Maybe they should be paying 25, 30% of all federal income taxes. So just be aware of that it is always very interesting and kind of striking to see the distribution of who's actually paying these federal income taxes, and it isn't necessarily what you may be hearing on the news. The next chart that we'll take a look at is dealing with lost decades. And this is looking at a 60-40 portfolio. And this is research that came out of GMO. And it's very, this is something that we talk about a lot at our firm, which is lost decades, meaning periods of time when a portfolio actually returned very little, maybe even was negative a little bit over a 10-year period of time, actually is more common than most folks think. And one of the outlooks that we have for this decade that we are in is that this may very well be a lost decade. And that just means having to be much more tactical and strategic in your fixed income allocation, which in the 60-40, 40% of that is fixed income. You have to be more strategic, especially in a volatile interest rate environment, in order to eke out returns wherever you may be able to do so. And certainly on the equity side, big concentration risks currently exist within the S&P 500. And at our firm, we're really oriented away from that in other parts of the U.S. market as well as internationally. And these are our strategies in how we can be prepared to not have, and hopefully not have, a lost decade in our portfolios. But unfortunately, it is more common than people think, and especially if people are getting close to retirement or in retirement, lost decades are really painful and really difficult to recover from. So this is where active investment management becomes so incredibly important, and monitoring your investments and your positions and evaluating them on a frequency, and certainly having an outlook and making sure your portfolio is prepared for that. The last chart that I'll share with you is related to real estate and mortgage rates. This was a survey conducted, and right now mortgage rates are back up around 6.5%, and only about 21% of the respondents say that they would be interested in purchasing a home over this, I think this was like the next 12 months or something like that, based on current mortgage rates. Well, the magic mortgage rate, according to this survey, is between 5 and 5.5%. Well, that's a really phenomenal rate, but there's quite a lot of decline that needs to happen before we could see that on 30-year fixed rates, being at right now a little bit in the 6.5 range, which only 13% of respondents say they would want to take out a mortgage. So, and you can see in the 3 to 3.5% or under 3, it's like 95-100% of people would take out a mortgage. So those days are behind us, we think, and we're not going back to those days anytime soon. And certainly folks took advantage of those in 2020, 2021, when rates were incredibly low. So most folks who do have 2.5%, 3%, or 3.5% mortgages, they're sticking to their guns. They're not going to sell their homes, and that's obviously creating supply constraints within the real estate market, and obviously impacting the number of transactions within residential real estate in particular. So just something to be aware of, that we may have some stickiness and some sluggishness in the housing market for some time until rates get more into that sweet spot range of 5 to 5.5%. If you have any questions, always feel free to reach out to us at info@alignwealthllc.com. Go to our website, alignwealth.com, and always feel free to submit questions to us through our Contact Us form. Thank you so much for joining me this month, and have a great rest of the month. Happy Halloween.